Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Massar and Tim Stenovec on Bloomberg Radio.
An update on the trade. We've got a bit of a rally underway, and we're up about 1.7% on the NASDAQ 100, a gain of just about 1 1/3% on the S&P 500. Curious to see what Bill Smead has to say about all of it. He's chairman and chief investment officer of Smead Capital Management. They've got roughly $5.6 billion in assets under management. The Smead Value Fund, it is down about 3% year to date, but has returned on average about 14% annually in the past 5 years. And the international value, Matt, I don't know if you noticed, is up about 21% year to date, so beating about 2/3 of its peers. Take a 5-year perspective, and it's beat just about all of its peers, returning on average 22% annually.
Yeah, and international has been crushing it this year. Interesting, because I talk to Bill's son all the time.
We do too, Cole.
But I'm chatting with him on IB like every day. And we're always talking about America. So it's interesting, Bill, to hear that you guys are doing well internationally. I got to ask first, though, about Portland. You're in Portland right now. You guys are usually in Phoenix. I just took a look, and Portland's got a nice semi-cloudy day, like 72 degrees. In Phoenix, it's 112. How much nicer is it in Portland?
Well, we have a summer home up here. So we've joined many Phoenicians by getting out of Dodge for about 70 days.
Makes sense. 112 degrees would be... For me, it would be rough.
I have to say I have family in Phoenix, and they used to come east for the summer months, or at least the kids did.
They always say it's a dry heat, but
hot.
that doesn't change how hot it is.
It's hot.
All right, so Bill, you guys have done well internationally. What's your focus on over there, and how do you gather your intel for international investments?
Well, there's a lot more spade work because in the U.S. fund, we deal a lot with things that we know a lot about and have interacted a lot with. And that's somewhat true on an international basis, but it's a lot of the same themes. We look for wonderful companies that are deeply out of favor. And it just so happens that the weakness in the dollar is causing the favor to come to those international companies a little easier than it does in the United States, where the dollar is strong.
Do you think that's going to continue in terms of the international returns or outperformance here?
Oh, it would seem obvious. The gap got the largest it's been, almost in 25 years. So the gap, anybody that doesn't have the Magnificent Seven in their index looks relatively poor. This is biggest undervaluation in the U.S. of value versus growth. It's the biggest spread of momentum to anything. And therefore, there was just lots of opportunity. There is lots of opportunity because these kind of things have a tendency to last for quite a while. And the international, on a relative basis, is just getting going.
Meanwhile, back here at home, you've drawn parallels to the incredibly narrow leadership that we have, right? The Mag 7 profits, Goldman Sachs said today, are going to grow 26%, whereas the rest of the S&P, the 493, are posting only 4% profit growth. You've drawn parallels between the narrow leadership we have now and 1987. That's a little bit spooky. How do you get there?
Well, what happened was there was a huge bull market from 82 to 87. And it got to where it got narrow, and it was kind of built around who Drexel Burnham was going to help get bought out, right? The R.J. Nabisco and some of those kind of things. So what we've got here is the biggest momentum trade of my 45 years in the business, and you don't get to know when it's going to end, but to be successful over the next 5 to 10 years, you're going to need to be in things that don't get caught in the outcropping of where this dies. And the signs of it dying are already there. Cole wrote a piece the other day just talking about how we loved these Magnificent Seven companies because they didn't have to put a lot of CapEx. They didn't have to reinvest a lot of their profits in the business, the Metas and the Googles and people like that. But now they're in a space race. They're in a race to see who can outspend each other. And when I saw somebody was offering an employee $200 million to go to work for them, I thought, okay, we're now at the kind of the goofy point.
So, okay, not so interesting.
It's silly season. I mean, it absolutely has to be silly season.
Listen, and this is what we're trying to figure out, right? But it does feel certainly lofty at this point.
Facebook is going to spend $20 billion just on compensation. That's not CapEx. That's OpEx.
Well, does this make you like something like Apple more so because they haven't, run into that AI spend? I mean, everybody's criticizing them that they're behind the game on that, but they're not doing that big spend, at least not yet.
Well, this is not stock-wise, but I don't like Apple because they're stalking me, and I don't like to be stalked. But anyway, that's a separate subject. Apple is a consumer products thing, and whether they're enhanced or invaded by AI, I don't know. But the bottom line is you can't make superior returns over a 10-year time frame from owning the best performing stocks of the prior 10 or 20 years. Mm-hmm. We've looked all through the decades. RCA wasn't the place to be after 1929, and Intel and Cisco have never made a new high from their 99-2000 peak. So Microsoft did get back to even after 15 years. So the problem isn't, can these work for another year or two? Yes, it's possible they can work for another year or two. All right. But when it's over is when the problem starts, and we have got the biggest concentration of not only in the S&P, but that means in everyone's portfolio. Almost everyone in the United States has got their portfolio built around the S&P, and the S&P is built around them. So if the S&P does poorly, those will get sold automatically, and if they do poorly, the S&P will get sold automatically in kind of a miserable, unvirtuous circle.
Bill Smead, 30 seconds here. We got to ask you, because everybody's like kind of looking at us. How is Apple stalking you?
I'll be talking to somebody about something, and the next thing I know, some kind of an advertisement will pop up on my phone for that subject.
Yeah, that happens to us too. I mean, I imagine, Carol, happens to you,
right?
Happens
it happens across everything.
It helps me shop.
We should point out that you also like Diamondback Energy. I know they're reporting after the close today, and D.R. Horton. We're running out of time. It just means, Bill, we're going to have to get you back real soon. Bill Smead, Chief Investment Officer, and so much more over at Smead Capital Management, joining us from Portland, Oregon.
You're listening to the Bloomberg Businessweek Daily podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
We're going to stay with technology, Matt and myself. The tech solutions provider, we're talking about Insight Enterprises, reported earnings last week. Shares did come under pressure, down as much as 18% intraday, the largest intraday drop since 2009 after second quarter sales missed analyst estimates. The stock is down more than 20% year to date. We wanted to hear more about the business, the outlook, and what is going on with IT spending more broadly. Here with us is Insight Enterprises President and CEO Joyce Mullen, joining us from Chicago. Joyce, welcome to Businessweek Daily. Before we get into the results, the outlook, just remind our audience about what your company does specifically and who your customer base is.
Yeah, sure. And thanks very much for having us today. Thanks for having me. Insight Enterprises has been serving enterprise customers, small and medium business customers, public sector customers for 35 years or so. And we have evolved many, many different times. We announced a couple of years ago that we were creating a new category in our industry. We're calling it Solutions Integrator because we have invested not only in our hardware, in our software capabilities and skills with our partners from around the world, but also our services expertise. And what we know is that buying patterns are changing. Enterprises really are looking for results. And the way you deliver results with technology, now more than ever with AI, is by combining hardware, software, and services. So that's what we do, and we're proud to do it. And yeah, we delivered a pretty resilient quarter in a Q2, considering all the headwinds. We met our expectations and expanded profit, but yep, the market dropped for our stock dropped for sure. And we're proud of the quarter we delivered. We just got to keep doing it, and it'll come back.
So why do you think the stock dropped so drastically?
Yeah, we're trying to figure that out. But, I think what we got to do is stay focused on delivering really strong results, expanding our margins like we've been doing, and then also making sure we take really good care of our customers. And our clients today are really focused on how do I put technology to work to deliver results fast, pragmatically, and simply. And this is what we've been focused on for a long time. We're pretty proud of the margin expansion that we saw in the quarter. We're really excited that Gartner named us as an emerging visionary in terms of all things AI. It's really the first time they've published that particular grid, and we're pretty excited about that designation. But we got to do it over and over again, and we're ready to do that.
You have, Joyce, the execution down. You have amazing experience at sales and supply chain orgs, massive businesses with Dell and with Cummins before that. But you've got to be able to deal with the capital side of the business too, right? So you need to know what shareholders are thinking and what they want. Or is that not, do you think it just comes if you continue to do your work?
No, of course. We are working really, really hard to build out our capabilities organically and inorganically as this market changes. I think AI presents enormous opportunities and frankly challenges. I think the traditional channel model doesn't survive an AI world where there's automated procurement and automated selling and all sorts of agents doing all kinds of work. And we are ready for that. We have been investing heavily in our own internal AI because if we're client zero for a bunch of our solutions that we've developed internally, we can also help our clients get those same results when we take them to them. And we've our number of AI assessments has more than quadrupled in Q2 from Q1. So we think this is really the catalyst that we've been excited about and preparing for many years. And now I think we're in a great position to deliver against those opportunities. But you gotta demonstrate results every single quarter, and I think that's what we're prepared to do.
How much of it though is that customers, and I think this came out in the reporting following your results, that customers are just putting off new projects and they're saving for what they think they might need in AI. How much of that is going on, I guess, and impacting your business?
Yeah, we have definitely seen that, specifically, Carol, in our enterprise infrastructure business. So our infrastructure business around enterprise, our largest customers. And there's a lot of excitement around AI. There's also a whole lot of uncertainty about how to proceed. So I think our customers are looking for those no regrets moves that they can make. How do they shore up their infrastructure, but maybe don't do the data migration work quite yet because they're not sure which workloads go where. We're definitely seeing that type of hesitancy. And that's a reflection of, I don't think we're an outlier on this, but that's a reflection a little bit of just changing spending patterns in those enterprise IT budgets and making sure that people are prepared and ready to spend on the things that are going to matter most in terms of their own AI implementations.
Is it because
the good news is,
yeah. Oh, no, please finish. Please, of course.
I was just going to say, the good news is whether they decide they need a much more robust network, or they decide they want to run a whole bunch of these large language models and smaller language models at the edge, we can help them. Or they're multi-cloud, we can help them. And that's the idea. How do we turn their concerns into shorter term, pragmatic projects, deliver results fast, and earn the right to do more?
How much of this I wanted to ask you, Joyce, is because they're smaller businesses or medium-sized business? And so I know that there's been this expectation that when it comes to AI, of having on-premise facilities versus, processing when it comes to AI up in the cloud. So how much of it is it that those smaller and medium-sized businesses maybe want to have it on-premise, but they want to hold off?
Our commercial business has grown 5 years in a row. So that's that small and medium business space. We are really pleased with those results. And normally, after we come out of a downturn, the commercial business grows first, and then we see that follow in the rest of the segments. And that follow-on work is just starting to take hold in our corporate segment, but the large enterprises are usually the last to grow as we come out of a down cycle. I do feel like there's a lot more discussion about which workloads should run on-prem, which workloads should run in public clouds, and we're ready for those discussions. And we help our clients optimize multi-cloud implementations every single day. So that's a huge opportunity for us.
I just noticed the statement that the enterprise tech buying model is broken, and I wonder how you think the new model looks.
Well, I think the new model is really around those pragmatic projects that are simplified and deliver results fast is sort of the norm. That's how we buy. We don't want a big engagement that spans 7 years. We don't want $100 million contracts around our technology services and solutions. We want smaller, bite-sized chunks so we understand what the ROI is, and then we use the returns on that investment to pay for the next one and the next one and the next one. And that's how our customers are buying today. That is a pretty significant departure from kind of how customers bought technology support and services maybe 5 years ago.
All right. Can I just ask you 10, 15 seconds? The pullback in spending, was it across industries or certain industries, just quickly?
Yeah, really, I would say it was more pronounced for large enterprise customers, more pronounced in those customers who serve consumers.
All right. Going to leave it there. Good to check in with you. Joyce Mullen. She's Inside Enterprises President and CEO.
This is the Bloomberg Businessweek Daily Podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Really looking forward to this next guest. Generac, I don't know if you noticed, Matt, was the top performing stock in the S&P last week. It was up 25%.
And it makes a product that I think a lot of homeowners, if you don't have one already, you want your own generator. And I guess with these climate issues that we have, more and more people are pushed to buy one. Let's bring in the chairman, president, and CEO of Generac, Aaron Yachtfeld. He joins us after second quarter earnings. And I guess, power gen has never been as exciting. You must be the most popular person at a cocktail party now, because it's not just a generator that people want at home, but because of the data centers and AI, everyone is talking about generating power. How's it working on your company?
Yeah, thanks for having me on today, guys. It's like you said, it's never a dull moment when you talk about backup power. Every time I travel, I get on a plane, you sit down next to somebody, you do okay, what do you do? What's your job? Where do you work? I talk about Generac, and all of a sudden, people are like, well, that's a product we have to have. I think what we've come to find just as Americans, we struggle with power quality in this country, and we have for many decades. This is not a new issue. I think, what's worrisome is just the number of outages that are happening and how long they're lasting. And this is a growing problem, both for homeowners as well as businesses.
Yeah. So how much, Aaron, of your business is, me and Carol out in the suburbs, and how much of it is a company, mid-size or even larger, looking to back up its data?
Yeah, about 60% of what we do is in the residential market. So that would be, out in the suburbs, for homeowners who are looking for a solution for their family, for their property, protect those things. Businesses, this is a business decision, right? With homeowners, it's a little bit different. It's a little bit more emotional, right? Just the loss of power and what can happen in your home. Certainly there's things that can go wrong. There's damage that can happen to your house. But largely, that's an emotional decision. Whereas a business, the loss of revenue, spoilage of inventory, some kind of interruption of a critical process, especially as things get more critical with in business with power, the need for that. We see about 40% of our business leaning that way, but that is a very large opportunity for us. And in particular, in some of the bigger applications where we play up in the data center market, it's an incredibly hot space.
Well, dig into that for us, Aaron. Like, how much growth are you seeing in that space? How many calls are you getting about that? Give us an idea of some of the demand and what that kind of gives you an indication of how much more that market could be for you guys.
Yeah, the market for data centers, obviously you guys cover this,
massive.
Very broadly. Yeah, it's massive, right? The capital spending that is going into these facilities and all the equipment that goes alongside of them is enormous. And of course, the power needs themselves are enormous. But you can imagine the backup power, right? These are critical installations. If the facilities go down, we don't have access to the cloud. We don't have access to some of these critical things that are happening in data centers. So every single data center that goes in has emergency backup power. And so we're a relatively new entrant to this market. Our product lines have been smaller. We've served small business and smaller data centers for many, many years. The telecommunications space, an example, is we provide backup power to a lot of the major wireless carriers out there. So this is a bit of a new space for us. We just entered it in April. We opened up our order book, and we've already booked $150 million worth of new business. We talked about that last week on our call. Mm-hmm. I think that was part of the reaction that you saw in the stock. But we're seeing just in incredible amount of demand for these types of products.
I'm always interested in where you're building these things. And I guess you have a new facility in Beaver Dam, Wisconsin, that's supposed to open up space to build those big diesel generators, more of the big diesel generators in Oshkosh. Tell us about your manufacturing footprint, because tariffs are obviously a huge issue these days.
Absolutely. And, we've been a longstanding U.S. manufacturer. We just opened our 6th facility in the state of Wisconsin. We have 7 here stateside. Those 6 facilities in Wisconsin, a good chunk of those facilities are focused on these larger units and on the commercial and industrial products. So those products for backing up businesses. But we're also a global company. We have facilities worldwide. We have a facility in China, a facility in India, Brazil. We have 3 facilities in Europe, and 2 in Italy, 1 in Spain. Have another facility down in Mexico. So, we're a global company, but we see, the demand for backup power growing, really across the globe. But we see what's going on here in the U.S. The addition of the Beaver Dam facility was a critical part of expanding additional capacity for these systems because the growth is it's enormous right now.
How much? So I look at cars all the time. Ford builds more cars in America for sale in America than any other producer. You'd think that would help them avoid tariffs, but in the end, they get absolutely crushed with tariffs on steel, tariffs on aluminum, tariffs on foreign-made parts, tariffs on magnets out of China. And it really makes up then more of a tariff hit than somebody building a car in Japan or somebody building a car in South Korea for export. Do you get hit with those kind of nickel and dime tariffs too?
We do. We use a lot of steel. We use a lot of aluminum. We use a lot of copper in every single gen set. So in fact, it's interesting you brought up the automotive industry, Matt, because it's a real good proxy for, a lot of our input costs, in terms of the components, in terms of the commodities, the things that we're exposed to. So, we have a lot of those similar exposures. And I think just like Ford and others, we're trying to do what we can to minimize the impact of tariffs, but it's difficult. I mean, we've all developed over the last, 40, 50, 60 years, global supply chains, right? I mean, there are areas of the world where, certain components, certain commodities are only available, right? They're just not widely available in other parts of the world. So it's going to take time to recalibrate those supply chains and to try and create a more domestic manufacturing base. And I get it. I understand the need to do that, in particular around things that are, associated with defense, maybe pharmaceuticals, things that are truly critical. I'm not sure, when you look at the broader base of things that we're putting tariffs on, that, like tennis shoes and Barbie dolls, if that's, maybe the right place to do it. I think we've got to be selective and we've got to be strategic in how we use tariffs. But I know the administration's, working through all of that with all these different trade partners.
Well, some things, I mean, like magnets or rare earths out of China, we're never producing those here. It's like not an option, not in decades. So
it's
there's
challenging.
And you must use those. Are you getting enough?
We are, we're fortunate that we have we have the ability to kind of substitute for some of those super rare earth elements that I think are really critical in aerospace and defense. Not as critical maybe in the automotive, and in smaller quantities they are, but we have access to them today. But of course that's a concern because, as you noted, there are only a few areas of the world where you can get those types of materials and those types of components. So it presents a really, I mean, this is a very complicated situation, very complicated conversation. I understand what we're trying to do, but again, I think we've got to be super strategic about how we implement these trade agreements and these tariffs.
We are talking with Aaron Yachtfield. He is Chairman, President, and CEO of Generac. Hey, a couple of things that you said I want to follow up on. You are mostly selling here in the United States, but you did talk about what you guys are doing around the world, Aaron. Does it make sense to pivot even more so international with the energy storage solutions to places like Europe and China, given that the U.S. policies are now less friendly to something like solar?
Well, those are big markets to begin with, right? So, obviously we want to be successful with our energy products, the storage products in particular, battery products. Europe is a very well-established market. The U.S., is a good market as well. But obviously the policy changes that we've now codified here recently are going to have an impact on the U.S. market for solar and for storage. Now, a lot of the things we're looking at, though, even with the loss of those incentives and the loss of support here in the U.S., the economics of putting a solar system on your rooftop, depending on where you live, as the cost of energy continues to rise, this is one of the things we've talked about. We started out talking today about the quality of power. The cost of power is another element here that needs to be talked about, because as power costs go up and the cost of these technologies around solar and storage continue to come down, the economics, the payback, the raw economics of investing in your own power production on your rooftop or a geothermal loop or however you want to produce your own power and store some of that power continue to improve. And the loss of support, it may impact the industry for a year or two, but it will get back on track because, again, power prices are going up.
Yeah, it does feel like we're headed towards a power war, certainly here in the United States, considering the amount of power needed to really support all the AI that's going on. Having said that, you talk about these loss of these residential tax credits. You've got some new home standby generators, my understanding, is coming to market. Is that going to help offset, though, some of the loss that you are seeing from those residential tax credits, especially when it comes to your energy storage business?
Yeah, absolutely. So on the energy storage side, the loss of the credits, that's going to impact that business here short term. Our home standby business, that business it's never benefited from tax credits to begin with. So, it's the kind of thing that again, if you and Matt out in the suburbs, you want one of these products to back up your home so that, you protect your property, protect your family. There unfortunately were no tax credits available, even though the administration, when President Trump was on the campaign trail, he had mentioned maybe perhaps offering a generator tax credit. We're still waiting on that. We think that'd be smart policy, but we haven't seen it yet. It certainly wasn't in the one big beautiful bill. But those products don't have tax credits. We do have a new product line coming out, which has got some great features and benefits packed in it. But those are the kinds of products that again, you're really buying and investing in those products to protect your home, to protect your family, to protect your business from a power outage.
No, and what I really meant is those new products kind of offsetting anything you're losing from the energy storage business because of the loss of the tax credits. One other thing I want to ask you about data centers. What about the imminent launch that you guys are expecting of large diesel generations for data centers? What can you tell us about capacity? How much do you guys have for that? And are you investing to boost that capacity? And what is the pipeline of new orders looking like?
Yeah, so the pipeline's very strong. Again, about 150 million already booked in backlog.
Okay.
In terms of capacity, just raw capacity here, kind of globally, about a $500 million capacity number for 2026. So if we get the orders, we think we can have a really great year next year as a way to increase our commercial and industrial business. But we're already thinking about 2027 beyond. This is a market that, again, you kind of have to go back to what do you see in terms of CapEx spending for data centers? Is this going going to be truly a bubble, something that in the next year or two, you're going to see a retrenchment or a retracement of all of that spending, or is this secular, right? Is this going to go on for the next decade? And we definitely, like others, believe that this is certainly a longer term trend and one worth leaning into. So we're already starting to think about adding capacity so that we can take that $500 million number to something much higher in the years ahead.
For me, it's the residential products, because this is like
Matt just wants a diesel generator.
It's like
Aaron.
a
I'm just going to lay it out
toy.
for you.
Well, if you're,
what we do here is just what Matt needs to buy, and that's what this is.
Not even me, but if you're like a hedge fund guy and you just made your first, couple of million, and you're putting up a place in, Millbrook, so you can be next to Mashomic, you want to have a sweet diesel generator out back.
Well, I'll tell you, what people don't think about, right? Like if you think about your home today, and right, so you talk about that hedge fund manager or anybody else who's got a home, the amount of technology that's entered your own home, right? Think about it, like from security cameras to just from control of all of your, a lot of your audiovisual equipment, your lighting, but a lot of the, the safety equipment that goes in your homes, your security systems. These systems are non-operational when the power's out. We get notes from people who are like, look, I didn't even realize that my garage door wouldn't open. I've got a garage door opener, the power's out. I can't even back my car out of the garage. Everybody, if your power's out and you want to open the garage door, you got to reach up and grab that red handle, right? Nobody wants to do that ever in your garage because you don't know what's going to happen next, right? So people are like, I didn't think about it. I didn't think my sump pump.
Aaron,
what happens when your sump pump?
My husband keeps doing all these systems, like our lights. I have to turn on with like these technical systems and everything. Nothing switches or anything anymore, and it's like I fear for when the lights go out. I don't live in suburbia. I live just outside New York City, but we talk about a generator too.
There's so much.
We talk
it's
about
not
a generator
just even
too.
the food in your refrigerator, but the deer in the freezer downstairs. And
no, it's not
what happens if you can't heat the pool in the fall? You need to have what is the hottest product, Aaron? What is the thing that the dude at the end of the cul-de-sac absolutely has to have? What are you selling out of?
Well, I'll tell you, it's our 26 kilowatt home standby generator, which can cover your entire house, a good-sized home, for everything you need. Basically, if the utility goes down, you don't even notice that the utility is not present, right? I mean, you see a momentary loss of power, and then the generator starts up, and you can basically run indefinitely on a natural gas pipeline, or if you have propane at your home, you're going to be able to last a long time on a generator. And I think the other thing that we're seeing, huge trend, right, is people who have home medical equipment, GLP-1 drugs. GLP-1 drugs have to be refrigerated. Yep. So if you lose refrigeration with medications, certain kinds of medications spoil very quickly. And so, these trends, these overarching trends for, again, a lot of the medical infrastructure is starting to move into the home. We see Americans who are trying to stay independent and stay in their homes much, much longer. But a power outage, when you get older, in your 60s or 70s, and you lose power, it's a very different situation than if you're a younger American, 30s and 40s. It's the indoor camping, you get out the Monopoly, and everybody has fun and it's great until, everybody gets sick of that after about an hour. But if you're older, I mean, the danger that comes from not being able to regulate temperature, the loss of some of the function of some of these medical devices, just not having the lights operate, as you mentioned, Carol. I mean, those are very serious situations for older Americans. And that is a huge part of our demographic for home standby generators.
Yeah, it moves from being a discretionary to a staple.
Not to mention the wine cellar.
Matt, stop.
Okay.
Aaron, he's now Googling what you just suggested. And so, there might be a purchase coming or something in Matt's future. Aaron, thank you so much. Aaron Yechveld, he is Chairman, President, and CEO of Generac. Delighted to have him here on Bloomberg Businessweek Daily.
You're listening to the Bloomberg Businessweek Daily podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
Hey, one name that is definitely outperforming in a big way in today's session, that is Wayfair. Stock is up about 12.8% as we speak, so pretty much hovering near its highs of this session. This after the company came out and reported second quarter results that were much stronger than expected. Our Bloomberg Intelligence, Poonam Goyal, putting out a research note saying Wayfair's second quarter heat looks to stay hot in the third quarter. So let's get to it. Let's hear about the business. Kate Gulliver is back with us. She's Chief Financial Officer of Wayfair, and she joins us once again from Boston. Kate, how are you?
Fine, thanks. We're thrilled with the quarter, so happy to be here.
Well, talk to us. I mean, investors are thrilled as well. Talk to us about the quarter and what you guys saw and where the growth was.
Yeah, I think you really saw two key things happening. So first, on the top line, our share gains continued to manifest and really accelerate, and that led to that 5% top line, 6%, adjusting for the German business comp. So that's pretty exciting for us. And then what you saw is a really nice flow through of that revenue to adjusted EBITDA, crossing that 200 mark, 205 of adjusted EBITDA. And I think that really shows the strength of the model and the efficiency of the cost takeouts over the last several years. So to have the nice revenue momentum, the share gains paired with that cost efficiency, for many quarters, we said you should see that really significant flow through when that happens. And indeed, that manifested in the second quarter.
Kate, whenever I ask someone about the stock price and it doesn't look great, they always say, well, we're focused on doing business here and we don't care about the shares. But you got to care about them on some level, especially as a CFO. So, you've had an incredible year. Year to date, you're up like 66%. But if I bring the chart out to, the COVID highs, you still have a long way to get back there. I think you're down 70 some percent from your 2021 highs. Is that going to happen, you think, at Wayfair, or was that just, like la land levels in the pandemic?
Well, now we're focused on operating the business, but
Sure.
let me unpack it a little bit for you, because the reason you probably hear that answer is at the end of the day, we do believe that the valuation and sort of where investors see the business should, over the long run, follow the performance that we drive here at the company. And so our focus actually really is on how do we continue to take share and how do we continue to flow through that revenue into adjusted EBITDA dollars, into free cash flow growth, and into a metric that we look at where we call owner's earnings, which is that EBITDA less our CapEx expense less our stock-based compensation. And we do want to continue to build on that over time, and we think we can. And as we continue to grow the top line, as we continue to grow those adjusted EBITDA dollars, I firmly believe that the valuation will follow.
But revenue, just
go ahead.
Can it get back to that? Or was that just like everybody locked in at home and the government throwing money at American citizens? Is that why revenue climbed so high during the pandemic? Or can you get back to that level?
Yeah, so if you think about the category itself, obviously the category itself had a very unique period during the pandemic where growth accelerated in the category in 2020 and into 2021. The category has had significant pullback since then in 22, 23, 24, and even still a bit in 25. We would say we think the category is sort of flat to slightly down, low single digits in the past quarter. So the category is still under quite a bit of pressure. Can the category return to a normalized level of growth? Of course, right? The category in a normalized period grows, sort of 3 to 4%, the overall home goods category. And we do believe that we can return to double-digit growth over time, where we significantly outpace the category. That's what we did for the majority of our history, significantly preceding the pandemic. And it's what we expect to do, as the category returns to normalization. So, can we ever get to the revenue that we had during the pandemic? Absolutely. We're quite confident in our ability to do that.
You mentioned earlier about cost efficiencies of the model. What specifically?
Yeah, so over the last few years, we've been quite focused on a few things. One has been improving our overall sort of total overhead cost structure. That manifests in that SOTG&A line in the P&L. And I would think about that as really our fixed cost basis. The majority of that line is labor. And so we have had a number of restructurings where we've reduced labor cost. And that has shown up in that line. And we've said that where that line is right now, at that $360 to $370 million point, it should be able to hold there for some time, even as we continue to grow the top line, we get ongoing efficiency from labor, and as we, sort of continue to see the benefits of some of the growth investments that we've made. So that's one big area of cost management. We also have been improving our sort of structural gross margin. So we took out, costs in our supply chain, and that's really helped our gross margin. And we've added some supplier services like supplier advertising, which have helped improve that gross margin as well. we've reinvested, a significant portion of that back in the customer experience in the form of price, in the form of delivery experience. And so we've held that gross margin at 30 to 31, but structurally we've been able to drive it higher and instead give it back to the consumer and then flow that through and ultimately, cover off on that fixed cost basis.
I wonder how you deal with tariffs because you have so many suppliers, but furniture making in the United States of America is far from its peak these days. So, do you get suppliers to kind of eat that? Are you taking some of it into your margin, and how much are you passing on to the consumer?
Yeah, what we talked about actually, in May, when Carol and I spoke before, was that we thought the benefits of our marketplace model would help us manage the tariffs. And that's because we are able, as you point out, Matt, we source from over 20,000 suppliers, right? So we were able to have a very wide range of goods with suppliers from all over the world, including some from the US. And we're able to then position within a given class or category, say like this chair that I'm sitting on now, we're able to position the products that we believe are best for the consumer. So most price competitive, can get to her quickly, are high quality. We're able to position that first in the sort order among many very similar products. So if a product gets relatively more expensive, other products will then move up within the sort order so the consumer is able to see the product that is most price competitive. And that means there's a tension within the marketplace where suppliers actually want to maintain their price competitiveness. They do not want to lose that volume, particularly in a category, as we spoke about earlier, that's been under pressure for some time. And you're seeing that pan out. So what we said on the call this morning was, on a like-for-like basis, for the products that are on those first few pages of the sort order, when you search for, sort of lounge chair, you're going to continue to see, and you are seeing, prices relatively stable on those first few pages. And that means that the products that the consumers are buying, they're not yet seeing, pricing changes flow through. And I do think that's due to the, breadth of suppliers that we work with. And the competitive nature of the marketplace.
We are talking with Kate Gulliver. She's the Chief Financial Officer of Wayfair, joining us from Boston. Hey, Kate, so what do you know about the type of shopping that consumers are doing? When they're buying, are they buying more items? Are they buying fewer items? Give us some idea in terms of some of the trends that you're seeing in terms of the actual shopping going on.
Yeah, it's a great question. So when we think about our average order value, or AOV, that's really comprised of three different pieces. One is like-for-like pricing, like we just spoke about. One is items per order, to the question you just asked. And then last piece is mix. And we actually are seeing a little bit movement on items per order and mix. So on items per order, we're seeing a little bit of increase, nothing major, but sort of moderate. But where we're really seeing momentum is on mix. And what we mean there is that we're seeing mixing in brands of ours that are actually sort of higher value. So Parag, which is our highest end, our luxury brand, we're seeing ongoing really nice momentum there. Our specialty retail brands, so All Modern, Joss & Main, Birch Lane, again, these operate a little bit above that mass segment that the Wayfair.com business operates at. Those are also seeing nice momentum. And then our B2B business, where we sell, to professionals and the trade, we're seeing nice momentum there. All of these are much higher ticket values than the sort of core Wayfair.com business. The other thing I'd add is, we're obviously newer to the physical retail game. We have our first sort of large format Wayfair store opened a little over a year ago. And we're seeing nice momentum in categories like storage and org and small kitchen accessories in the physical space as well.
Do you want to keep continuing to add in terms of the physical stores? I know you guys have some more expansion going on.
Yeah, no, great question. We're thrilled with the performance of that Chicago store. Really two key things that we see there. One is the halo effect, so the sales that we get in the surrounding region from having the store there. And then two, within the store, we're seeing nice momentum in categories that, maybe sort of underpunch a little bit online, like storage and org, kitchen accessories, small appliances, that kind of thing. And so as we look at it, we see significant opportunity from a growth perspective in expanding stores. We've actually announced 3 additional leases. 2 will open in 2026, one in Atlanta and one in Denver. That's our first store in sort of the Mountain West region, so we're very excited about that. And then early 27, we have a store opening in Yonkers, New York. So, you can see us starting to build some of the momentum here. That'll be a little closer to home for you guys.
Yeah. Hey, Kay, I wonder about your view on rates because, maybe if you're buying just one chair or a side table, you can afford that. But I'm sure a lot of Americans are putting stuff on a plan or borrowing money. And today the 10-year is pretty low, but the idea, I think, is that rates are going to tend to go up from here. What's your view?
Just got about 30 seconds, Kate.
Yeah, I would actually say in our business, actually, the average order size is only around $300. So, while rates have an impact on the consumer overall in terms of the housing market, in terms of her purchasing with us, it's, largely not financed.
All right, gonna leave it there. Always fun to check in with you and get a really great view of what's going on with the consumer. Kate, be well. Kate Gulliver, she's the Chief Financial Officer of Wayfair.
This is the Bloomberg Businessweek Daily Podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.